Step 9. Building wealth through long-term investments. Building wealth is a long-term journey, and one of the most effective ways to generate sustainable wealth over time is through long-term investments. While many financial strategies focus on short-term gains, long-term investments provide the compound growth that can turn small contributions into substantial wealth. To successfully build wealth through investing, it's important to approach it with patience, strategy, and a clear understanding of the types of investment vehicles available. By diversifying your investments and sticking to your long-term goals, you can gradually grow your portfolio and achieve financial independence. The importance of a long-term mindset in investing. Patience is your ally. Patience is a cornerstone of successful investing and wealth building. The most successful investors understand that wealth is not built overnight but through steady, consistent growth over time. This long-term approach is key to navigating market fluctuations and reaping the benefits of compounding growth. When you invest with a long-term mindset, you're not focused on short-term gains or quick profits, but rather on the sustained growth of your wealth over many years or even decades. One of the main advantages of long-term investing is the ability to ride out market volatility. Financial markets can be unpredictable, with stock prices, bond values, and other assets often experiencing fluctuations in the short term. However, over time, these assets tend to appreciate in value, provided they are sound investments. By staying the course and holding onto investments through ups and downs, long-term investors allow their portfolios to grow steadily without being swayed by short-term market noise. For example, during market downturns or periods of economic uncertainty, many investors panic and sell their holdings to minimize losses. While this may seem like a rational move in the moment, it often results in locking in those losses. Selling during a market dip can prevent you from benefiting from the eventual recovery. On the other hand, patient investors with a long-term perspective tend to see market downturns as opportunities rather than threats. These investors are more likely to stay invested or even increase their positions by buying quality assets at lower prices. When the market recovers, those assets have the potential to provide significant gains, rewarding those who had the foresight to remain patient. The power of patience is also amplified by the concept of compounding returns. Over time, the interest or dividends earned on investments can be reinvested, allowing your wealth to grow exponentially. This compounding effect can significantly increase the value of your investments over the long term, even if the returns in the short term are modest. By staying invested and allowing your investments to compound, you maximize the growth potential of your portfolio. In essence, patience is an investor's ally because it allows you to weather the natural ups and downs of the market, avoid making rash decisions based on fear, and take advantage of opportunities for growth when they arise. It's about taking a step back, trusting the process, and understanding that wealth building is a marathon, not a sprint. By maintaining a patient mindset and sticking to your long-term goals, you position yourself to benefit from the growth of your investments over time, which is the key to achieving lasting financial success. The power of compound interest. Compound interest is one of the most powerful forces in wealth building, and understanding how it works can transform your approach to investing. The principle behind compound interest is that it allows you to earn interest on interest, which means that not only do you earn returns on your initial investment, but you also earn returns on the interest that accumulates over time. This effect creates a snowballing effect, where your wealth grows at an accelerating pace as the years pass. The key to harnessing the full potential of compound interest is time. The longer your money stays invested, the more pronounced the compounding effect becomes. Early on, it may seem as though your investments are growing slowly, but over the course of several years, this growth begins to build on itself, creating exponential gains. This is why starting to invest early, even with small amounts, can have such a dramatic impact over time. For example, let's consider an investment of $10,000 in a mutual fund with an average annual return of 8%. In the first year, you would earn $800 in interest, 8% of $10,000. In the second year, however, you would not only earn interest on your original $10,000, but also on the $800 of interest that you earned in the first year. This means that you are now earning 8% on $10,800, which results in an interest payment of $864 for the second year. Over time, this compounding effect accelerates, leading to greater and greater gains. After 10 years, your $10,000 investment would grow to approximately $21,589, almost doubling in value, simply due to the power of compound interest. This example demonstrates how compound interest works in your favor when you stay committed to long-term investing. Each year, your money earns more because it is working not just on the principal you initially invested but also on the returns that have been generated over time. The true magic of compound interest lies in its ability to generate significant growth over the long term. While short-term gains may seem modest, the long-term impact of compound interest can be transformative, especially when reinvested in assets that continue to grow in value. This is why it's often said that time in the market is more important than timing the market. The longer your money is invested, the more you can benefit from the compounding effect. By starting to invest early, being consistent with your contributions, and allowing compound interest to work its magic, you can build wealth at a pace that would be difficult to achieve through other means. Whether you're investing in stocks, bonds, real estate, or other assets, the power of compound interest is a vital tool that can help accelerate your wealth-building journey. Dollar cost averaging, DCA. Dollar cost averaging, DCA, is a strategy that helps investors manage market volatility and reduce the emotional pressure of trying to time the market perfectly. Instead of trying to predict the best time to invest, DCA involves committing to invest a fixed amount of money on a regular basis, such as weekly, monthly, or quarterly, into a specific asset or portfolio, regardless of the asset's price at that moment. This strategy takes the guesswork out of investing by ensuring that you are consistently putting money into the market, no matter its fluctuations. The key benefit of dollar cost averaging is that it helps smooth out the volatility of market prices over time. By investing regularly, you automatically buy more shares when prices are lower and fewer shares when prices are higher. This helps to lower the average cost per share over time, reducing the impact of market ups and downs. As a result, you aren't as vulnerable to making emotional decisions based on market movements, which can often lead to poor investment choices. Instead, DCA encourages disciplined, consistent investing. For example, let's say you decide to invest $500 every month into a stock fund. In 1 month, the price of the stock might be $10 per share, so you would buy 50 shares with your $500 investment. In the next month, if the price of the stock rises to $12 per share, your $500 investment would only buy around 41.67 shares. In this way, the number of shares you purchase varies depending on the price of the stock, but you're consistently investing the same amount. Over time, this strategy smooths out the volatility, and the average price per share you've paid ends up being lower than if you had tried to time the market or made lump sum investments during market peaks. Over the long term, DCA can be a powerful tool for building wealth. It allows investors to take advantage of market fluctuations without the need for complex timing decisions or emotional reactions. Since the strategy is focused on long-term growth, it helps mitigate the risk of investing a large sum of money at the wrong time, which could happen if you try to buy all at once when the market is at a high point. In addition to reducing the risk of market timing, dollar cost averaging helps investors maintain consistency and discipline, especially during periods of market volatility. It's a strategy that promotes regular investing habits and is particularly useful for those who may not have the time or expertise to closely follow the market. By adopting DCA, investors are essentially taking advantage of the power of steady, incremental investments, leading to potential wealth accumulation over time. Ultimately, dollar cost averaging is a strategy that aligns well with a long-term investing mindset, as it encourages regular contributions and reduces the emotional stress of market timing. It helps you stay the course through market fluctuations and ultimately allows the market's upward trajectory to work in your favor over the years. Real estate as a wealth-building tool. Real estate investment, a tangible asset. Real estate investment is widely regarded as one of the most reliable wealth-building strategies because it offers the unique advantage of being a tangible asset. Unlike stocks, bonds, or other financial instruments, real estate allows investors to physically see and manage their investments, providing a sense of security. There are several ways to create wealth through real estate, each offering its own set of benefits and challenges. Owning rental properties is one of the most popular methods. When you purchase a property and rent it out, you can generate consistent rental income. As tenants pay rent, you not only create a steady cash flow but also build equity in the property as its value appreciates over time. Over the long term, property values typically increase due to inflation, urban development, or improvements in the neighborhood. This can provide significant financial returns. In addition to the potential for appreciation, rental properties also offer tax benefits. You can deduct expenses like property depreciation, mortgage interest, repairs, and property management fees, reducing your taxable income. For example, purchasing a single-family home for $250,000 and renting it out for $2,000 a month results in $24,000 per year in rental income. Even after factoring in expenses such as maintenance and property management fees, you could still be left with positive cash flow, while the value of the home continues to increase over time. If the home's value increases by $100,000 over 20 years, that's a significant boost to your net worth. In addition to rental properties, investing in commercial real estate can offer higher returns, albeit with larger initial investments. Commercial real estate includes office buildings, retail centers, industrial warehouses, and other properties intended for business use. These properties typically offer higher rental income potential because commercial leases tend to be longer and rent payments can be more substantial than residential leases. However, investing in commercial real estate often requires more knowledge and capital than residential properties. But the potential rewards, such as long-term tenants with higher rents, can make it a lucrative option for investors seeking greater returns. Another strategy within real estate investing is flipping houses. This approach involves purchasing properties that need renovation, making improvements to increase their value, and then selling the property for a higher price. House flipping can be a profitable way to create wealth, but it requires expertise in the real estate market, renovation costs, and timing. To succeed in flipping houses, you need to carefully assess potential properties, accurately estimate renovation expenses, and know how to sell the property at a profit. Flipping houses can yield high returns, but it also carries risks, such as overestimating the renovation costs or being unable to sell the property at the desired price. Real estate is an excellent option for building wealth through tangible assets. Whether you choose to invest in rental properties, commercial real estate, or flipping houses, the potential for consistent cash flow, long-term appreciation, and tax benefits can help you grow your wealth over time. However, each strategy requires thorough research, careful planning, and proper financial management to ensure success. Stocks, bonds, and mutual funds. How to use them effectively. Stocks, a stake in a company. Stocks are one of the most popular and widely recognized investment options because they offer the potential for significant growth over time. When you buy stock, you are purchasing ownership in a company, which means you have a stake in its success. As the company grows, its stock value typically increases, which can lead to capital gains. Investors can also benefit from dividends, which are payments made by companies to their shareholders out of profits. One of the major attractions of stocks is their potential for high returns. Since stock prices can increase substantially over time, early investments in successful companies can lead to large gains. However, this potential for high returns comes with a trade-off. Stocks are also known for their volatility. Stock prices can fluctuate widely due to various factors such as changes in the company's performance, the overall economic environment, market sentiment, or industry trends. This volatility means that stock investments can experience short-term losses, which can be unsettling for some investors. The key to successful stock investing lies in choosing companies that have strong fundamentals and long-term growth potential. Strong fundamentals refer to a company's financial health, profitability, growth prospects, and competitive advantages. Investors typically seek companies with a track record of solid earnings, a robust business model, and a strong management team. Focusing on companies with the ability to grow over time and weather market volatility can help reduce risk and increase the chances of long-term success. For example, if you decide to invest in 100 shares of Apple stock at $100 per share, your initial investment is $10,000. If, over the next 5 years, the stock price increases to $200 per share, the value of your investment would double to $20,000. This increase in value demonstrates the potential for growth that stocks offer. However, it's important to remember that stock prices don't always rise. They can fluctuate due to various factors like economic conditions or company-specific challenges, and sometimes they can even decline temporarily or for extended periods. To minimize risks while investing in stocks, many investors take a long-term approach. They hold on to their investments for years, allowing the companies to grow and recover from any temporary market fluctuations. This patience is often rewarded as companies with solid fundamentals generally tend to appreciate over the long run. Additionally, diversification, investing in a variety of stocks across different sectors or industries, can help spread the risk and improve the overall stability of an investment portfolio. Stocks offer a great opportunity to participate in the growth of companies and potentially earn high returns. However, this comes with risks, and it requires a strategic approach, including careful research, diversification, and a long-term mindset. By focusing on companies with strong fundamentals and growth potential, investors can build wealth over time, despite the inherent volatility of the stock market. Bonds, lower risk, steady returns. Bonds are a popular investment option for those seeking lower risk and steady returns. Unlike stocks, which represent ownership in a company, bonds are debt securities issued by governments, municipalities, or corporations. When you purchase a bond, you're essentially lending money to the issuer, and in return, the issuer agrees to pay you regular interest payments, known as the coupon, over the life of the bond and return your principal investment when the bond matures. Bonds are generally considered safer than stocks because they offer more predictable income streams and are less affected by short-term market fluctuations. The interest rate on a bond, also called the coupon rate, is determined at the time the bond is issued. The bond issuer is legally obligated to pay you interest regularly, typically semi-annually or annually, and repay your principal investment when the bond matures. Because bonds have a fixed income component, they tend to be less volatile than stocks and are seen as a more stable investment option, particularly for conservative investors or those nearing retirement. While bonds are less risky than stocks, they also tend to offer lower returns. This is because the issuer's obligation to pay you interest makes bonds a safer investment, but the trade-off is that their growth potential is more limited. Bonds do not provide the same high returns as stocks, which can grow exponentially over time. However, this lower risk and steadier income make bonds an attractive choice for individuals seeking stability and predictable cash flow, especially in a diversified portfolio. For example, if you purchase a 10-year bond with a 4% annual interest rate, you would receive $40 in interest for every $1,000 invested each year. Over the course of 10 years, you would receive a total of $400 in interest payments, plus the return of your $1,000 principal when the bond matures. This predictable cash flow is appealing for investors who are looking for regular income without the volatility that stocks can sometimes experience. Bonds come in many different types, including government bonds, such as U.S. Treasury bonds, municipal bonds, issued by state or local governments, and corporate bonds, issued by companies. Government bonds, especially those issued by stable countries, are generally considered the safest type of bond, while corporate bonds may carry higher risks depending on the financial health of the issuing company. For those approaching retirement, bonds can be an ideal investment choice because they provide a steady stream of income that can be used to cover living expenses. Additionally, bonds tend to perform well in times of economic uncertainty when stocks may be more volatile, making them a useful tool for balancing a portfolio and reducing overall risk. However, it's important to note that bonds are not without risk. While they are generally safer than stocks, they are still subject to risks such as interest rate risk, credit risk, and inflation risk. If interest rates rise, the value of existing bonds can decline, and if the issuer faces financial difficulties, there's a risk that they may not be able to repay the bondholders. Inflation can also erode the purchasing power of the bond's fixed interest payments over time. Bonds offer a lower-risk investment option that can provide a steady stream of income and return of principal. While they may not offer the high growth potential of stocks, they are an essential part of a well-diversified investment portfolio, especially for individuals seeking stability and predictability. By balancing bonds with other assets, investors can reduce the overall risk of their portfolios and ensure a more stable financial future. Mutual funds, diversified investment. Mutual funds are a popular investment option that allows investors to pool their money with others in order to invest in a diversified portfolio of assets. These funds are managed by professional portfolio managers who make decisions about which securities, such as stocks, bonds, and other assets, should be included in the fund. Mutual funds offer several advantages, particularly when it comes to diversification, professional management, and accessibility. One of the main benefits of investing in mutual funds is the instant diversification they provide. Rather than investing in a single stock or bond, mutual funds invest in a wide range of securities. This diversification helps spread risk across different assets and sectors, which can reduce the overall volatility of your investment portfolio. For example, if one of the companies within the fund experiences a decline in its stock price, the negative impact on your investment is mitigated because the fund holds shares in many other companies. Additionally, mutual funds allow individual investors to access a broad range of asset classes that they might not be able to invest in on their own. The fund may hold stocks from different industries, bonds with varying credit ratings, or even international securities. By pooling resources, mutual funds enable investors to gain exposure to a variety of markets and sectors without having to purchase each individual security themselves. This can be especially valuable for those who may not have the time, knowledge, or resources to manage a diversified portfolio on their own. For example, imagine you invest in a mutual fund that holds 100 different stocks. Your investment is spread across a range of industries, such as technology, healthcare, consumer goods, and energy. As a result, even if one of the companies within the fund performs poorly, your overall investment will not be significantly impacted. Conversely, if other companies in the fund perform well, they may offset the losses of the underperforming company. This built-in diversification is one of the key reasons why mutual funds are appealing to many investors, particularly those who are new to investing or those who want to reduce their risk exposure. Another advantage of mutual funds is that they are typically managed by professional fund managers who have experience and expertise in selecting and managing investments. This is ideal for investors who don't have the time or knowledge to pick individual stocks or bonds. The fund manager's job is to select the best possible securities to achieve the fund's investment objectives, whether that's growth, income, or a balanced strategy. This professional management adds value by ensuring that the fund is being actively monitored and adjusted to meet its goals. Mutual funds also offer liquidity, meaning that you can buy and sell shares of the fund at any time during market hours at the current net asset value, NAV, which is the value of the fund's assets minus its liabilities, divided by the number of outstanding shares. This liquidity makes mutual funds more accessible and flexible compared to some other investment options, such as real estate, which may require more time and effort to sell. However, mutual funds are not without their costs. Most mutual funds charge management fees, which are used to compensate the portfolio manager and cover the operational costs of running the fund. These fees can vary depending on the type of fund, and some funds may also charge additional fees, such as sales loads, a commission for buying or selling shares. It's important to be aware of these fees, as they can eat into your investment returns over time. In addition, there are two main types of mutual funds: actively managed and passively managed. Actively managed mutual funds involve a portfolio manager who actively selects and buys securities in an attempt to outperform the market or a specific benchmark. These funds tend to have higher fees because of the active management involved. On the other hand, Passively managed mutual funds, often called index funds, seek to replicate the performance of a specific market index, such as the S&P 500. Passively managed funds generally have lower fees since they require less active management. Mutual funds are a great option for investors seeking diversification, professional management, and ease of access to a wide range of assets. They are ideal for individuals who may not have the time, expertise, or resources to manage their own investments, and they can help reduce risk by spreading investments across multiple securities. While there are fees involved, the benefits of diversification and professional management make mutual funds a valuable component of many investment portfolios, particularly for long-term investors. The value of reinvesting profits and dividends. Reinvesting your earnings for growth. Reinvesting your earnings, whether from dividends, interest, or capital gains, is one of the most effective strategies for wealth accumulation. This process, known as compounding, allows your initial investment to generate returns on itself, accelerating growth over time. Instead of taking profits or dividends as cash, you reinvest them into the same investment or other assets, which allows your wealth to grow exponentially as the reinvested funds continue to generate more income. When you choose to reinvest your earnings, you are essentially using the profits to buy additional shares or assets. These newly purchased shares will then begin to generate additional dividends or interest, which in turn can be reinvested once again. This creates a cycle where your investment continually grows, not just by the returns it initially generated but also from the returns on the reinvested earnings. Over time, the effect of compounding becomes significant, as your portfolio begins to grow at an accelerated pace. For example, imagine you own dividend-paying stocks and receive $500 in dividends each year. Rather than cashing out and spending the dividend, you choose to reinvest that $500 to buy more shares of the stock. The following year, you now own more shares than before, so the next dividend payment will be based on a larger number of shares. This results in a higher dividend payout, which can then be reinvested again. The longer you continue to reinvest your earnings, the more your wealth compounds and grows. In addition to increasing the number of shares or assets you own, reinvesting earnings also helps to reduce the impact of market volatility. When prices are lower, reinvested dividends can purchase more shares at a lower cost, which may benefit you in the long run as the market recovers. Conversely, when the market is performing well, your reinvested dividends will buy fewer shares, but they may be worth more as the value of the underlying investments increases. The power of reinvesting is most apparent over the long term. The longer you allow your earnings to compound, the greater the growth potential. For instance, if you invest $1,000 in a portfolio that averages a 7% return annually, after 10 years, your initial investment would grow to approximately $1,967. But if you reinvest your earnings during that time, you could potentially reach a significantly higher value. The reinvestment of dividends and interest accelerates the growth of your portfolio by continuously adding more capital to your investments. Moreover, reinvesting is particularly effective in tax-advantaged accounts, such as retirement accounts like a 401k or an IRA, where the earnings grow tax-deferred or tax-free. This allows you to maximize the benefits of compounding since you don't have to worry about paying taxes on your earnings in the short term. By reinvesting in these accounts, your wealth has the potential to grow without any immediate tax burden, which can result in a more substantial retirement nest egg over time. Reinvesting your earnings is a powerful tool for long-term wealth building. By choosing to reinvest dividends, interest, or profits rather than cashing them out, you allow your investments to grow exponentially over time through compounding. This strategy not only accelerates the growth of your portfolio but also minimizes the impact of market fluctuations and maximizes the potential of your investments. Over the years, this can significantly increase the value of your assets and put you on the path toward achieving your financial goals. Understanding the power of diversification and risk management. Diversification, spreading risk across multiple assets. Diversification is a key investment strategy that aims to reduce the overall risk in a portfolio by spreading investments across various asset classes, such as stocks, bonds, real estate, commodities, and international markets. The rationale behind diversification is simple: different assets react differently to the same market conditions. By diversifying, you decrease the likelihood that your entire portfolio will suffer from a downturn in any single asset class. This strategy helps smooth out the volatility in your investments and provides a more stable long-term growth path. The key benefit of diversification lies in its ability to reduce the risk of significant losses. If you concentrate your investments in one sector or asset class, you expose yourself to the full impact of any downturn in that area. For example, if you invest all of your money in technology stocks, your entire portfolio could be severely affected if the tech sector experiences a significant decline. On the other hand, if you diversify your investments across a range of sectors, asset classes, and geographic regions, the negative performance of one area can be offset by better performance in another. Consider a portfolio that consists solely of technology stocks. If the tech sector experiences a downturn due to factors like increased regulation, market saturation, or economic conditions, the value of your entire portfolio would be negatively impacted. However, if your portfolio is diversified and also includes real estate, bonds, international stocks, and perhaps some commodities like gold, the poor performance of the tech stocks may be balanced out by gains in the other areas of your portfolio. For instance, bonds typically perform well during economic recessions when stock markets are down, and real estate might appreciate or provide steady rental income regardless of market volatility. Moreover, diversification isn't just about spreading investments across asset classes but also about spreading investments within each asset class. For example, in the stock portion of your portfolio, you can diversify by investing in different sectors, such as healthcare, energy, and finance, and in different regions, such as domestic and international markets. This way, you further minimize the risk of a single market or industry affecting your entire portfolio. Another form of diversification is through the use of mutual funds or exchange-traded funds, ETFs. These funds pool money from many investors to invest in a broad array of securities, such as stocks, bonds, or other assets. By investing in a mutual fund or ETF, you gain exposure to a wide range of individual securities, achieving diversification without having to pick and manage each investment yourself. It's also important to note that diversification does not guarantee profits or protect against losses in a declining market. While it can help reduce the impact of volatility, some degree of risk is always present. However, over the long term, a well-diversified portfolio tends to outperform a more concentrated one because it smooths out the fluctuations and minimizes the risk of catastrophic losses. For example, imagine a portfolio consisting of 60% stocks, 30% bonds, and 10% real estate. During a market downturn, the stocks may lose value, but the bonds might provide stability, and the real estate investments could generate rental income. In times of economic growth, the stocks and real estate may perform well, while the bonds provide a steady income. This balance allows the investor to stay invested during difficult times without taking on excessive risk in any one asset class. In summary, diversification is a crucial strategy for managing risk and building a resilient portfolio. By spreading your investments across different asset types and sectors, you reduce the impact of market downturns on your overall portfolio. This approach not only helps protect against potential losses but also positions you for more consistent, long-term growth. Whether you achieve diversification through individual assets, mutual funds, ETFs, or a mix of strategies, it is a powerful tool for both risk management and wealth building. Risk management, balancing growth and protection. Risk management is a critical aspect of investing, and it involves understanding and balancing the risks associated with your investments in relation to your financial goals, time horizon, and risk tolerance. The goal is to make sure that your investment portfolio reflects the level of risk you're comfortable with while optimizing the potential for returns. Every investor has a different level of risk tolerance. Some may be comfortable with high levels of volatility and the possibility of losing money in the short term in exchange for higher potential returns, while others prefer more stable, lower-risk investments that provide steady growth over time. The key is to tailor your portfolio to suit your unique situation, as well as your long-term financial objectives. Your risk tolerance is influenced by several factors, including your financial situation, your investment knowledge, and your psychological comfort with fluctuations in the market. For example, younger investors with longer time horizons may be more inclined to take on higher risk, as they have the ability to recover from market downturns over time. On the other hand, investors nearing retirement or those who depend on their investments for income may have a lower risk tolerance and prefer more conservative investments that prioritize stability over growth. The time horizon for your investments is another important factor in determining the level of risk you can afford to take. If you have a long-term time horizon, you have more flexibility to weather short-term market fluctuations, as your investments have more time to recover and grow. In this case, you might be able to invest more heavily in growth assets, such as stocks, which carry higher risk but offer the potential for higher returns over time. On the other hand, if your time horizon is short, such as in the case of an investor who plans to retire in a few years, it may be more prudent to prioritize stability and choose assets that are less volatile, such as bonds or dividend-paying stocks. Risk management also involves balancing growth assets and protection assets within your portfolio. Growth assets, such as stocks, real estate, and alternative investments, tend to offer the highest potential for returns, but they also come with higher volatility. Protection assets, such as bonds, cash equivalents, and some types of insurance, help shield your portfolio from large losses during market downturns and provide stability in times of uncertainty. A well-diversified portfolio allows you to manage risk by spreading investments across different asset classes. For instance, if your portfolio consists mainly of growth assets, you can mitigate risk by including some protection assets. This helps reduce the impact of market volatility on your overall portfolio performance. Bonds and other fixed-income investments tend to perform well when stocks are struggling, and they can help preserve capital during periods of high uncertainty. A key component of risk management is also understanding the risks associated with specific assets. Different asset classes come with different types of risk. For example, stocks carry market risk, the possibility that the price of a stock will fluctuate based on market conditions, and business risk, which is the risk associated with the performance of the company issuing the stock. Bonds carry interest rate risk, meaning that the value of bonds can decrease if interest rates rise. Real estate comes with risks related to market conditions, property management, and changes in demand. Understanding these risks allows you to make informed decisions about how much risk you are willing to take on in each area of your portfolio. One effective approach to risk management is asset allocation, which involves dividing your investments among different asset classes to create a balanced portfolio. For example, an investor with a high risk tolerance and a long-term time horizon may allocate a large portion of their portfolio to stocks, while an investor with a lower risk tolerance may allocate a larger portion to bonds or cash equivalents. Over time, it's important to periodically review your portfolio and adjust your asset allocation to reflect changes in your risk tolerance, time horizon, and market conditions. Rebalancing is another essential part of risk management. As market conditions change, the performance of different assets will vary. Rebalancing involves adjusting your portfolio periodically to bring it back in line with your desired asset allocation. For example, if the stock market has performed well and your portfolio's stock allocation has increased beyond your target, you may want to sell some stocks and invest the proceeds in other asset classes to maintain the balance between growth and protection. Overall, risk management is about finding the right balance between growth and protection, making sure that your portfolio aligns with your risk tolerance and financial goals. By carefully selecting a mix of assets, monitoring your portfolio, and making adjustments as needed, you can reduce the risk of significant losses while still positioning yourself for long-term wealth building. Whether you prefer aggressive growth or more conservative stability, effective risk management can help you navigate the complexities of investing and keep your financial goals on track. The bottom line: building wealth through long-term investments requires discipline, patience, and strategic planning. By investing in a combination of stocks, bonds, real estate, and other vehicles, diversifying your assets, and reinvesting profits, you can harness the power of compounding and take advantage of growth opportunities. Whether you are just starting or are an experienced investor, keeping a long-term mindset will help you navigate market fluctuations and steadily grow your wealth over time.